Maverick Traders. Welcome out to your live trading event. Nice to be here with you. We're going to look at scanning. We're going to look at idea generation, how we come up with different concepts. And to start, I'm going to talk about something I'll call special situations. And it's something that I like to trade a lot are these special situations. And I think as you gain experience in the market, you too will like to trade these because when you think about the markets, a lot of what makes us money is when we can find something in the market that's kind of maybe a special situation or some sort of circumstance that the market's not valuing or judging as well as we can. And that's kind of what we're looking for is maybe where the public, it's usually the general public. The general public tends to get some important turning points wrong. They tend to get too fearful at the bottoms and too optimistic at the tops. And, with special situations, they kind of overdo it. They get all bulled up or all bared up, and that creates opportunity. So let me give you a few examples recently. Twitter has been in a buyout situation with Elon Musk, and there's been news circulating about this. Will the deal go through? And you can kind of, as you understand the markets, you can actually start to see opportunities with that. Where there's risk and reward, of course, in any trade you take, but we took advantage of Twitter's probability that either the deal was going to go through at a lower price or Elon Musk was going to walk away from it. And I highlighted in the market roundup some put spreads that if, I traded them, but if you had traded them, you can have made hundreds of percent return. They were $5 wide put spreads that were going for $1, just around $1. So you had a 4-to-1 reward to risk ratio on something that had a very high likelihood that it was going to be priced differently, so that would cause the stock in Twitter to fall and those put spreads to go up, or that Elon Musk would walk away from the deal and Twitter stock would go down and those put spreads would go up. And the probability, I felt like, was greater than 50-50. So that's a special situation where, in my mind, it was a better than 50-50 chance that Twitter stock was going down, and it had a 4-to-1 payout. That doesn't happen every day in the market unless you kind of get special situations. Last week in the market roundup, I highlighted a trade on Amazon, and it was going through a stock split. And I talked about how now that the stock split had passed, so the actual stock split took place on Monday, and the market kind of jumped in on that in terms of, I think a lot of the public will go rushing in. Oh, the stock price is down. In fact, I even saw articles. How dumb is the market? There were a bunch of articles going around that Amazon was down 90% or whatever because it went through a 20-to-1 stock split. Of course, the stock price just got adjusted. The stock wasn't down, it was the same value, right? It's just taking one big pizza and slicing it up into 20 slices. It was the same amount, but since the stock price went down, the public kind of rushed in to buy, and that was on Monday. On Tuesday after the bell, I said, again, this was a special situation where I was bearish. You can buy put spreads on this and have a greater than 2-to-1. Again, it was more like 3-to-1, actually, reward to risk ratio on that stock trading down to 113 or lower per share. And by the end of the week, that had certainly transpired. And again, I felt like the probability of success on that was pretty high. The public tends to buy, you have to wait for the stock split to happen. You have to give it that day or two where the public kind of floods in. You don't want to short it before the public. You want to kind of say, okay, has the public had their chance? Have they come rushing in to buy for no good reason, essentially? And now it gave us a setup. It gave us a signal, and it was a bearish price pattern. So again, I think my odds of success on that were probably going to be 50-50 or better. And again, it was a better than 3-to-1 reward to risk ratio, but it had special circumstances around it. Sometimes it's a bullish scenario. I traded Occidental Petroleum, an energy company, to the upside. And part of the reason I did that was because Warren Buffett and Berkshire Hathaway started to buy a stake. Now, usually when you get news that Berkshire has taken a stake, usually it's not news. There's four investment decision makers at Berkshire Hathaway. Warren Buffett, who's the big one, he trades multi-billion, huge position sizes. And then there's smaller players. I guess Charlie Munger's kind of Charlie and Warren work together. But then there's two others, Todd and Ted, as they call them. Ted Weschler has an amazing track record, by the way, but those two decision makers trade smaller size and they're much more active. And so usually you get headlines like Berkshire Hathaway bought into XYZ stock. And most of the time it's a non event. But on occasion, it's a big, huge position. It's a multi-billion-dollar position that's only growing larger, and that signals it's Warren Buffett. And when that happens, that's significant. That is where you say, okay, there is very likely to be some follow-on buying, not just by him, by the way. He's buying such a huge position size that it takes him a while. When it was announced that they had started a stake in Oxy, he had started buying in the 40s. He kept buying all the way up into the 50s and even towards the 60s. There were multiple days, multiple weeks, and by the way, a huge price move where he was still increasing his stake and building that position. So I took positions. I did a couple of different bullish trades on Oxy during that period of time that worked out wonderfully well. So I would call all of these special situations because you're just simply watching for news, for things that you can kind of dissect better than the general public for sure. And you can look at the risk to reward of it and say, okay, where's my setup? Where does it get to the levels where I'm going to take my stance? What's the timing on this? In the case of Twitter, it was immediate. In the case of Amazon, we needed to wait a couple of days until after the stock split was actually taking place, right? Give it a day or two for the public to kind of make their buys that are kind of silly buys. But anyway, buying on a stock split, it's actually, if you buy on a stock split, buy on the announcement. Back when Amazon announced the stock split, that's usually where it's going to go up. By the time it actually splits, that's where the public comes in, and that's not so good. So you could say a special situation for stock splits would be if a stock split is announced, a lot of times there's a quick buy there to buy it up. But once the stock split is actually going through, which takes place a couple of months later, that's one that we can kind of fade a day or two after the event. Or, some big market mover like Warren Buffett. Sometimes there's share buybacks. Speaking of Warren Buffett, his own Berkshire Hathaway, I traded that to the upside for many months because they kept announcing that they were buying back their own shares. And I knew that Warren Buffett and Berkshire Hathaway were putting about $6 billion per quarter at least into buying back their own stock. So think of it this way. If you know that, $6 to $10 billion is guaranteed to be coming into a stock, all else being equal, the odds favor that stock going up. That means that they basically have eliminated $6 to $10 billion worth of willing sellers. So even if there are $6 to $10 billion worth of willing sellers out there, well, now you're back to break even. But if somebody tells you they're just going to keep pumping huge amounts of liquidity into a stock on a quarterly basis, the odds do favor it going up. Doesn't mean it's going to go up every day, every week, every month. But Berkshire Hathaway instituting a huge share buyback, plus they're well respected, plus it was a change from what their normal mode of operations were. People were saying, look, if it's good enough for them, it's good enough for me. And and Warren Buffett does his fundamental homework and so on. So there was a lot to like, and I traded that to the upside for many months during that period of time when those share buybacks were instituted. That one's kind of interesting because the stock has fallen off quite a bit. And as it's fallen off quite a bit, the probability that they're going to come back to this, they kind of slowed their share buybacks because A, their stock price had gone up so much, and B, because they found huge energy plays that they wanted to take. They put $20 billion into Oxy and about $20 billion into Chevron just in the first part of this year. So that's $40 billion worth of investments into two energy companies. They kind of changed their focus there for a while and started buying energy aggressively. Well, now energy's gone up quite a lot. They probably have most of the stake they want. I think they might come back to this. So Berkshire Hathaway, have it on the watch list. You might have another 6 to 10 billion per quarter that's almost guaranteed to come back in if they start to institute those share buybacks. So whenever you hear news, if anyone thinks of any news event that comes out, you can actually dissect that and say, okay, probability, risk and reward. Sometimes there's buyouts. Activision is being bought out by Microsoft. Microsoft came out and said, hey, we like your business. We want you to become part of Microsoft. They agreed to a deal. And it's interesting, the deal and all the things that are happening here. First of all, the deal's not expected to close until like middle of next year, like July 2023. So that's part of what's happening, is it's a long ways off. But the stock itself is trading at like 75-ish per share, something like that. The deal where Microsoft is going to pay is at 95 per share. So this is something of a special situation. This is called merger arbitrage, where you could basically say, well, I can arbitrage this. I have a locked in sell price at 95. They've already agreed to pay that. So assuming the deal goes through, which is not guaranteed, by the way, either of these two could back away from the deal. There could be regulatory approval that it doesn't pass, whatever. There could be things that derail this. But if I buy today, I know where my sell price is likely to be, assuming the deal goes through. So I have $20 of upside. That's not a bad return on a stock that I'm paying 75 for. Think of it on a 1-year basis. That's 26% return on investment, assuming the deal closes next year. So 26% in 1 year, not bad. Well, here's the risk. The risk is that this deal falls apart and the stock plummets this way. And now you wake up and your stock's worth 55 and the deal is now done. It's not going to go through. You're not going to get 95. You could be down 20 points in this if the deal falls apart. But we could look at this special situation and try to value it and say, okay, well, what's the probability of this deal going through and at what time, and what would be a good risk to reward trade for taking advantage of this and so forth. And that's what I wanted to do today, is basically look at, well, how could we play this merger arbitrage idea and potentially come up with a game plan for it, assuming that we think it's going to go through. So I'm going to go to Activision. And we know we've got to go out a long time because you really want to match up. I mean, this is part of why people wouldn't love this, is they'd say, well, heck, I'm sitting in this trade for a year, okay? But it's not going to tie up a lot of money in the options market. I think you're going to see why this could make sense. It's going to be like watching paint dry, yes, because this doesn't expire. This doesn't settle for 367 days. Now, here's something that's kind of interesting. Let's say that this deal closes on May 20th of next year. I'm just making up a number, okay, making up a date. If it closes on May 20th, what happens is your expiration gets pushed forward to that because Activision no longer trades. It's done. The deal is done. The stock is gone. And Microsoft paid every shareholder $95 for it. So if it closes in May, even though you have a June expiration, you'll get your money and it will all settle out in May. So if the deal closes before your expiration, it'll fast forward that expiration. That's a good thing. Okay. Now, that's why we need to buy enough time though. What if the deal didn't close until after June? What if it didn't close until, July or August? Well, we might not have enough time here. What if the stock made, part of its move toward the buyout price after our expiration? Well, then we wouldn't get that move. Our deal would close at whatever our expiration is if the deal date was after that. Our trade would finish before the deal ever closed. So we might even look at January 2024. Again, this expiration will be pushed forward, assuming the deal goes through. So if we go look at January 2024, these are called LEAPs, long-term equity anticipation securities. And we have already our exit price in mind. We know the deal is agreed to at $95 per share. So that $95 per share is probably the option we're going to be selling in this case. Okay. Now, we're probably going to be collecting somewhere around 70 cents or whatnot for that option. Then we need to buy an option against it. And we could look at some different choices here. Let's say that we wanted to buy, it's kind of interesting how big of a drop. I'm not sure why. This would be $3 to $4 and this would be, very, very low priced. It's a little bizarre how much lower the 95 is than the 90, but it makes sense in that the market's saying, well, the deal's going to be struck at 95. There's not much value in betting on it being above that. So there's kind of some weird bid-ask spreads, not a ton of liquidity, but let's kind of make sense of this together. You could even, so let's just build kind of a standard. I'm just going to look and eyeball these. So that would be about $6. Would probably be about a 1-to-1. Let's go down here even further. What if we went 75.95? Okay, so I'm gonna try this. Let's build a butterfly. And a butterfly, usually the options you short are going to be at the strike price where you think it's going to go. So in this case, that's 95. And generally speaking, we say, well, you're probably not going to land perfect on a butterfly. In this case, you probably are going to land perfect. You're probably going to land perfectly on 95 if, you kind of assume that the deal goes through. They're going to pay you 95 per share. That's exactly where it's going to close and settle out. Now, this particular trade goes for about $10.69. So I'm not seeing kind of the pricing I want to see. That's about a 1-to-1 reward to risk ratio and quite expensive. If we're going to get a 1-to-1, we may as well go to something else like that, 85, 95, 105, and you're still at like the 1-to-1, but you've got considerably less capital tied up in it. Out of curiosity, what if we did it a little bit skewed? Let's see what this looks like. So that's going to pay you 5. It's only going to have, or it's going to cost 5, pardon me. The only thing is, if the deal goes through at 95, you're going to lose 5 there, 5 there. So you're probably going to end up at about $5 a profit for $5 of risk. But that one's kind of interesting. Maybe a little bit more interesting than the others. And let me show you why. The idea here is to build a butterfly that has a payoff somewhere in that 95-ish range. Now in this particular case, We're going all the way out to next year, a year and a half away. And it kind of shows you in terms of this trade. Let me set the break evens to that expiration. It shows you that you're going to make money if the stock's anywhere between 100 and about 80 bucks per share. That's your profit zone. Well, we think it's going to settle at 95. And if it settles at 95, you'll make about 500 bucks. The reason I like this structure is not, it's kind of weird. We didn't put the peak at where we think the stock's going to end up, but we got a better risk to reward. If for some reason this deal went through at 90, we'd make more money. But see, we're only paying $4.94 for this. So our max risk is a little less than 500 bucks, and our probable reward is about 500 bucks. So we're back to that 1-to-1 reward to risk ratio, but it actually prices out better to do it this way, 75, 90, 105, than to put the body of the butterfly at 95. For whatever reason, it's kind of prices out that way. We risk less, we probably make a little bit more, and if something weird were to happen, we even have a bigger payoff on this one. But I think this type of trade makes sense because think about the probabilities. First, what's most likely in our view? Number one, the very most likely outcome is that the deal goes through. I would give it, I mean, we know Microsoft has the money. Deals like this get regulatory approval all the time. In fact, EA, Electronic Arts, has kind of, they've said the magic words for we're willing to be bought out. And the magic words for that are when they say they're looking at strategic alternatives. They've hired an investment bank to consider strategic alternatives. That's deal talk. That's, hey, we're up for sale. Who wants us? So I think the deal is probably going to go through. And let's just say, I mean, let's give it a 60% probability of that happening. Number two, we got to look at our risk, and it's 494 bucks is the worst we can lose on this per butterfly. Well, what's our reward? We're probably going to land at 95 and make basically the 500 bucks. But you could, and let me put this still on number three, you could make up to 1,000 bucks. You know, if for some reason the deal was to go through closer to 90. Now, there's a lot of time between now and January, and this is probably the worst aspect of it, is, yeah, you're trying to make a 1-to-1 reward to risk ratio, but you got to wait many months to do it. So sometimes you can get these deals and build structures like this that look more attractive than this one. But I think the reason this one's only paying more 1-to-1 is because the market realizes this, that the deal is likely to go through. So number four, I mean, what I don't like about it is the time you have to be in this. It'll be like watching paint dry. You also need to be very careful with your execution prices. Make sure you use limit orders. Try to pay as little as possible for this type of deal. Really get a good price execution and stay patient in waiting for it to hit your price. If we look at Activision, when the deal was actually announced, the stock jumped up, as you can see, and then it's kind of whittled off since then. We're down here at 74.80 and whatnot, and have kind of been pulled down by the markets, but nothing has really come out that this deal has fallen apart and so forth. There is concern in the markets. The reason the stock price has drifted lower is because mainly the market's worried that maybe one of the deals, one of the parties is going to back out. Specifically, Microsoft might say, well, rough economy, maybe we could have paid a lower price. Maybe we'll back out and pay Activision $1 billion or something for the breakup fee. It's possible, but I don't think Microsoft is scared off yet. If it gets, if the economy gets considerably worse or something, I suppose this deal could start to fall apart. But kind of an interesting look at playing a deal. Admittedly, I don't love this one. I didn't find it to be a super compelling situation, but we highlight these often. Good question. Do you look at abnormal activity, abnormal buying and selling in the options? A little bit, but not much. It's not really something that I would call my bread and butter. What you're referring to there, you can actually find, if we go abnormal option activity, there's some scans. If you go to bar chart, this is the one that I was thinking of, barchart.com. Here it'll list the stock, and you can look at whether it's a call or a put, and what strikes, and how much, days to expiration, and what was trading, what the volume is versus the open interest, and so on. And what I would personally look for would be for huge, something that's just really out of the ordinary, something that really stands out. Like, Apple trading 12,000 is probably not that big a deal. Institutions trade that all the time. But you can see a few of these. So there's a 10,000 in Tesla, probably not that big a deal either. But the maybe the first one on the list was kind of interesting, this QD. There were 12,000 contracts traded against only 132 open interest. That tells you the reason that the volume being much larger than the open interest is interesting is because if the open interest is super high, let's say the open interest is 30,000, then the volume trading 12,000 might just be them closing their trade. But if the volume is high and the open interest fairly low, well, we know this is new trading. This is new activity. This is new positions being built and established. Now that particular one, this is a $1 stock apparently. So again, I would throw that out by looking at it a little bit closer. There was another one down here, RDBX. Okay, they're coming after the $5 strike puts. Again, anytime it's kind of more of a penny stock, $5 or less, I'm not as interested. Let's see if there's anything in the abnormal activity that really stands out as being, significant. Okay, so again, lower price point, 850 strike puts, and there's quite a bit of open interest in those as well. Just gonna see if I could see anything that really stood out. You'll get the usual suspects. I mean, Amazon is always going to have big institutional activity. Nvidia is always going to have big trades. LAZR, the 7 strike puts. Somebody coming after those aggressively. Let's go look at what that LAZR is. So you can see it's, somebody's coming after those puts, and the stock's been in a big downtrend. I don't trade off of abnormal activity much. I don't find it to be super successful. I know there's a couple of the Nigerians on CNBC that kind of tout that, but in my opinion, they're kind of doing the public a disservice. They are kind of pumping something that they already got into. And because they buy the options, then they go on CNBC and proclaim the abnormal activity and the public rushes in to buy. It elevates that implied volatility of those options and really boosts their value and instantly makes those Nigerians money, essentially. And then I'm not surprised when they quickly get out of those. I mean, it's kind of it's weird to me. It's sort of a CNBC pump and dump scheme they've got going there. It doesn't smell right to me. So, but anyway, the idea behind abnormal activity is basically spotting something that's happening in the actions of the market that you can take advantage of, that somebody knows something that others don't. I just find it's usually smoke and not a lot of fire. It's usually not something. I mean, there's always examples of, hey, this one really was, it was the real deal, and somebody knew something and the stock went crazy, and if you'd have followed that abnormal activity, you could have made a great return. Okay, show me the other 9 or 10 that had the exact same signal and didn't do anything. So I'm not big on that. That's not one of my main. I can't remember the last time I ever traded off of kind of abnormal activity. I don't find that to be quite as attractive as some of the other ideas. But Activision, that being a merger arbitrage, in stock splits, huge company buybacks, just different things that happen that kind of make you go, okay, is this something that the public is really interested in? And what's the public's opinion? What's their stance? Are they getting, if the public really universally loves or hates something and kind of piles in, then it's like a pendulum. As soon as they kind of pile in to whatever that is and push it too far this way, the as it swings back the other way, that's your opportunity. That's really where the best situations come in. So, hope you've enjoyed this live trading class. Have a great rest of your week. Always fun to do these, and we will see you next time. Goodbye, everyone.